Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 4th of May. I'm Daniel Lam, your host for the podcast. Now, I did not actually stop working during my 2 weeks of paternity leave. For example, I've kept doing this daily podcast in the mornings, and I've been learning many new opening strategies for chess in the evenings, preparing for the Asian Games in September later this year. I would love to continue to change and to evolve. Indeed, change was the theme from the FOMC decision overnight. Now, as expected, the Fed delivered a 25 bips rate hike this time, but in the post-meeting remarks by Powell, the key sentence about the committee anticipating some additional policy firming, that sentence was removed from the May statement. Moreover, Powell revealed that while there was strong consensus behind the 25 bips increase, the policymakers did discuss the possibility of pausing for the next meeting. Powell also talked about the fact that over the past 6 to 7 weeks, the Fed has been focused on the economic implications of credit tightening, the results of the latest Beige Book, as well as the Senior Loan Officer Opinion Survey, which is due to be released on May the 8th. So it appears that we are likely to see the pause in rate hike. But Powell did note that if inflation evolves according to the FOMC's forecast, then rate cuts would not be appropriate in the second half of this year, because core services ex-housing inflation has not yet rolled over. Now, what does that mean for your portfolio? Well, for those looking for a Fed pivot, i.e. rate cuts in the second half of this year, they should have been slightly disappointed by this FOMC. So as we are now entering a stage of Fed pause, we could well be going into a stage of a good news is good for the market's mantra, and vice versa. Now, because the US earnings season is coming to an end soon, and we are facing the volatility from the debt ceiling debate, as well as slowing economic data, investors should consider fading US equities. They should consider rotating into high-quality fixed income. Looking at US 10-year yield, 3.6% level is a strong level of resistance, and it seems to be, once again, testing the 3.3% support. And lastly, gold is gold. DXY is once again testing support at 100.80, and a weak US dollar bodes well for gold. Gold broke above resistance level at 2048, and momentum is on the upside. Moreover, gold is likely to benefit from safe haven demand arising from the debt ceiling debate. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.